So for this week's Forex in 5 over in developed markets, in the US, despite some low inflation prints, we've seen the case strengthening now for 3 cuts in 2024. Probably going to see the same in 2025. Obviously, Jay Powell is pushing his agenda quite strongly. Obviously, there'll always be some opposition in the FOMC, but the dot plot, what the institutions are thinking, is all going down the sort of same route of 3 cuts this year. Now, we all thought that the Fed were going to be the first to blink. However, recent inflation data in Germany, for example, has shown that European inflation is actually dropping at quite a pace. So we're starting to get murmurs that maybe it's the ECB who blinked first. The forecast originally was for sometime in June to see some rate cuts. However, we may see that coming sooner rather than later. So we might see a bit more euro weakness. I mean, it's been traded within quite a tight range, broadly speaking, over the last few months, but now we suddenly might see some weakness versus the dollar. GBP in the UK is probably going to follow a similar suit to Europe. Inflation figures are tracking thereabouts the same, so we're now starting to price in a bit more, not necessarily dollar tightening, but we're not going to see the loosening that we expected first in the US before the UK and Europe. Over in emerging markets, in Nigeria, it's been quite an interesting situation, actually. We've seen that the CBN have been intervening via USD supply for some time now. However, they've been sort of targeting lower rates with a smaller amount of volume. So this sort of dynamic is a bit different to what they did towards the back end of last year, where they were trying to put big volumes into the official window. We're now seeing them selling dollars around 100 points below where the official rate and the parallel rate's tracking, but in much smaller quantities, both to sort of retail and to the BDCs. So the trend over the last month or so has been aggressively downwards in the rate. Clearly, it's been fueled by things like the bank holiday, etc. in the UK, but it remains to be seen whether this has got further to go. Sort of 4 months ago, when we originally broke through 1,000 on the rate, it was quite a landmark occasion. Now suddenly we're trading at 1,200, 1,300 sort of levels, and it feels really low compared to what we've seen over the last couple of months. So there probably is some room for it to fall further, but that remains to be seen if we continue to see this intervention. Clearly, fundamentally, the economic landscape in Nigeria hasn't changed too much. Okay, there's been like a lot of monetary policy tightening, which is a positive. The asymmetric rate corridor for borrowing and lending has tightened quite a bit. So there should be a lot of Naira liquidity being pulled out of the market, which should suggest the rate to move lower, but we will need to see some sort of inflationary impact from rates being tightened. Over in Kenya, we mentioned before about Kenya being added to the FATFA grey list. It was met with not a lot of fanfare, but we've since seen Moody's, the credit rating agency, sort of downgrading and giving their comments on Kenya, which obviously isn't the best scenario. However, the rate seems to be coming down more and more. We've seen in the past it's been very much dominated by whether banks are willing to sell dollars. However, the rate's pretty tight at the moment. There's not a lot of imbalance in terms of supply and demand, so we're just sort of floating around the very low 130 levels in Kenya. In Tanzania, literally over the last week or so, we've seen quite a big reversion in the rate, having climbed quite a lot over the last couple of months above 2,900, not really dominated by any sort of macro fundamentals, but more from a liquidity standpoint. That's now starting to reverse a bit. We're starting to see rates pull back into the 2,800 levels, which is probably to be expected. We've been sort of expecting it for a couple of months now, but it was very much like catching a falling knife. But the fundamentals, the macro side of things in Tanzania continue to be positive. So if there is some legs to the rate dropping, it wouldn't surprise us too much. Overall, I guess in Africa, the big story is potentially like which country is going to be issuing Eurobonds. Kenya are quite adamant they're going to be issuing a Eurobond this year. Nigeria likely to follow suit, plus some of the other West African territories. So that should be quite interesting to see, because sort of last year we didn't really see a lot of Eurobond issuance across the whole of the continent, really. So it's quite a positive standpoint for the whole of the MFX, well, across the frontier naturally. Finally, in ZAF and ZOF in the last few seconds, the ZAF market has become incredibly tight again. We've seen sort of settlement delays across the board, so it's not having an immediate impact on the rate itself, but there has been some sticking points where liquidity has gone particularly dry in some places. Zoff, however, is still trading a bit more freely, so we're sort of still looking about 7% above the peg on ZAF and sort of 3 to 4 on Zoff.